Hey, welcome back to another video, and today we are going to go over what is a bond. So there are a lot of misconceptions out there. It's almost like that, that kindergartner out on the playground who heard his parents say something, and they heard something about the levels of risk, and they heard a lot of things about this thing, and so they just kind of like go out there and they say what their intuition tells them. But today we are going to peek a little bit deeper than intuition. We're going to go into what exactly is a bond. If you do like these videos, make sure you give them a thumbs up. And if you want to support the channel, there are some links down below. You can get yourself some free money. And lastly, we have a Facebook group going on that I need to get used to announcing at the beginning of the videos, because we got a millionaire mastermind that I'm starting. And anyways, let's get right into this topic. So what is a bond? A bond is a loan for a project. So whatever that is, could be a loan to a government, it could be a loan to a company, whatever they want to build out. It's just a loan so that entity can do that. So how do bonds work? This is basically how bonds work. A loan is issued. That's step number one. Step number two. A coupon is paid over the term of the bond. So it could be a 2-year bond, it could be a 3-year bond, 10-year bond, 30-year note, whatever. A coupon is going to be paid. So let's say that you got a $5 coupon on a $100 bond. So you're loaning somebody, let's say I'm loaning you $100, and I say I want $5 per year over the course of the bond. So that would have a 5% coupon. Now the percentage is not determined by the amount that was loaned. It just has a coupon attached to it. So back in the old days, you would actually get a coupon and you would mail in that coupon so that you could get the money back for that bond from the company, entity, government, whatever. So I see that mistake in dividend stocks and also in bonds, where people think that this pays a certain percentage of whatever it is currently worth. That is not the case. If something goes up in price, like if the bond goes up in price, the coupon rate stays the same and the yield goes down. So what percentage, based upon what you paid, it's going to go down as the price goes up, and vice versa. So we said loan is issued. Coupon is paid over the term of the loan, and at the end of the bond, the face value is paid out when it comes due. Or in addition, a bond issuer, or the person that is asking for the loan, receiving the loan money, the loan, they can either pay out the face value of that bond, or they can refinance it, which that gets into basically, you'll have to determine what the rates are at the time of refinancing that bond. So next on the agenda, who are the bondholders? What are their rights? Because that's very important. So the bondholders hold a lien against assets of the business, and the stockholders hold a claim to profits, equity, and dividends. So there's a very clear distinction there. The bondholders have a lien against the property, while the stockholders have rights to the profits. So the bondholders, in other words, get paid first, then you get into preferred shares, which we're not going to talk about those, preferred dividends, preferred shares. Then after that, the stockholders have rights to the profits of that company. You'll see this on the balance sheet as their interest charge. So the interest charge is going to the bondholders, or in other words, the people who gave the company a loan for whatever it needed. So next thing, are bonds safer? Bonds have a limited upside potential and not a limited downside potential. So a lot of financial advice out there says that bonds are safer, or bonds are there to protect your downside. Well, that is true under normal conditions, but these are not normal conditions. Basically what we have is we have the Federal Reserve going out there and lowering the risk-free rate so low that it just can't go any lower. It's reached near zero. It's basically zero. Because of inflation, it's actually, the real rates are negative. So what bonds usually do in a portfolio is basically when stocks go down, bonds tend to go up. The reason for this is because when stocks go down, they also tend to start cutting dividends. They start to see a reduction in income. But those bonds, it's more likely that those are going to keep on paying out. So if you're an income investor, you're more likely to keep your income within the same company if you hold the bonds rather than if you hold the stock. So dividends are going to get cut first from the common stock and then from the preferred shares. And then if they can't pay the loan or they default on the bonds, they're basically going to have to sell their stuff, sell the stuff that the bondholders have a lien against. So back to our bonds safer. Bonds have a limited upside. So in other words, the most that you can make on a bond is the amount that you put in, getting that back at the end, plus all of the coupon payments over the term of the bond. So let's say that just to make a simplified version of a bond, let's say that I'm giving you a loan of $100 for 3 months, and I'm saying you need to pay me $5 a month for these 3 months. So the most that I can make is my $100 back, and I can make $5 3 times. So the most that I can make is $115, right? It doesn't matter how well the company does, that is the most that I can make. So they have a limited upside. They have no limited downside, because if I give you this loan to go make your $100 company and your $100 company goes bust, then those bonds will go bust because you're not going to pay back that money. So that's a very important distinction to make, that a bond does not have an unlimited, protected downside, but it does have a limited upside. So when we talk about safety, a lot of people conflate the terms safety and volatility. So bonds are less volatile, and that's just due to their nature. So because of how they function, they are a loan that's going to be paid back at the end of the term of the bond, and they have a coupon. So they don't change much. No matter what earnings do, they don't change much. You're either going to pay it back or you're not going to pay it back. So most of the merit in bonds has to do with whether or not it's going to be paid back. So any movement in a bond price has to do with whether or not investors think that is going to be paid back. But like we said before, the upside is limited. So who issues bonds? We already went over this a little bit, but basically who issues bonds are companies and governments. And what they can get on their bonds, or in other words, what they have to be charged by an investor, has to do with their credit rating. So right now, the credit rating of the U.S. is pretty good, so they can get pretty cheap loans. And other companies, say like when Tesla had those bonds that were about to go bad, they have to pay a little bit more for their bonds because investors don't have faith that they're going to pay their bonds back. So if people don't think you're going to pay your bonds back, like say Zimbabwe or some country that doesn't have the best credit rating, doesn't have the best record of repayment, people are going to want more. They're going to want more of what they call a risk premium for those bonds to give you a loan. In other words, what I'm saying is, hey, I don't trust that you're going to pay me back. So for every loan that I give to someone like you, I want to make more money to make up for the fact that some of people like you are not going to pay me back. So when we think about these bond price movements, we have to think about it from the perspective of the investor. What is the investor trying to do? The investor is trying to take some of their capital, they're trying to buy something, and they're trying to increase their capital. So bond price movements, let's get into that. And with that, we're going to get into the risks. So we've got interest rate risks. So the way that bond prices move with relations to interest rates are, if you get, let's go back to that $100 bond, $100 loan, and it's got a 5% coupon. So it's paying out $5 a year because $100, $5 a year, 5%. Well, if interest rates go down because the Fed pumps the market full of money and starts buying up basically government treasuries, which is the risk-free return. If the government starts to buy up those risk-free returns, then essentially what you're going to see is lowering in the interest rate, because the government debt also has a coupon. So if that coupon is not moving, the coupon does not move. When the price goes up, because that demand from the government is increasing from the Federal Reserve, which is not the government technically, but it really is, but it's not the government technically. When that demand goes up, the price goes up, the yield goes down. So that affects all of the other lending markets. So when somebody knows that prices of bonds are going up and yields are going down, those new bonds are worth less. So essentially what you have with interest rate risk is when interest rates rise, bond prices will generally fall. And that's because the old bonds are going to be worth less. Let's say that we had that bond that was paying that $5 for $100. If interest rates rise, well, now let's say they go to 7%. Now I can buy a bond for $100 that's paying 7%. Well, I still need to make my 7%. Now I'm in an environment where I can make 7% on my money. So basically what has to happen is that 5% needs to fall in price to the point where it's yielding 7%. And vice versa. When interest rates fall, bond prices typically tend to rise, because if interest rates fall, let's say it was at $5 and interest rates fall to 3%, well, now that $5 coupon needs to adjust in price. That $100 will adjust to, I'm just going to guess, about $120, $125, so that you can get to that 3% that the Fed has basically set interest rates at. So all of the interest rates tend to normalize around the same price because, like we said, an investor is going to put their money into the best position that they possibly can to get as much money out of it as they possibly can. Inflation risk. So the inflation risk of a bond is essentially if that had a really long term, let's say that 5% that I'm paying out has a really long term, and let's say that inflation one year hits, let's say the first year inflation hits 10%, which if you look at shadow stats, if you look at the real rates of inflation based on the way that we used to take it, the real rates of inflation have been pretty high in the past, in the recent past. So, but let's just say it hits 10% and you're being paid out 5%. Well, now what has essentially happened is that 5% interest, besides the fact that it's going to be taxed as ordinary income on bonds, you're also getting hit with an interest. You're also getting hit with an inflation tax. So you're basically putting in $100 and it's worth 5% less after you get paid out that 5%. So you're losing 5% on your money by buying that bond. That's the effect of the inflation risk. So that kind of brings into question, what are bonds doing right now? So right now, since interest rates are so low, the only way for interest rates to go are up. And like we just said, when interest rates rise, bond prices generally fall. As far as are bonds safe, they're just an instrument that you need to understand. So next risk of a bond is the issue of time. So the time of the issue, the longer that you give a company or a government to hold your money, the more risky it becomes. So essentially, the longer someone has to default on your loan. So if you think about like a 15 versus a 30-year mortgage, a 30-year mortgage, somebody has a longer time to default on that loan. So it tends to have a higher interest rate on that loan. If you look at 15 versus 30-year mortgages, you'll see that. So longer issues have longer to fight against inflation as well. So you never know what the central government or central bank rather is going to do as far as, causing inflation through printing money. So there's more inflation risk. There's more risk holding a bond over a 30-year term because you don't know what's going to happen necessarily. So you're going to, as an investor from the investment side of things, you're going to demand a higher interest rate for a longer issue. Next thing is the federal government can print money to cover their bonds. So essentially, like we said before, the federal government is the risk-free return. So it's important to understand that the risk-free return is a very important factor on bond prices and bond interest rates, because that is the risk-free return. So if people want to take on absolutely no risk, that's basically a floor on bond yields. So if I can get more money out of my capital with no risk, I'm going to shift over into those federal government bonds because they can just print me some money if things go bad. Next topic of discussion is TIPS, or Treasury Inflation Protected Securities. So essentially what these are treasuries from the government that are protected from inflation. So they're basically designed to pay out an inflation adjusted amount. So whether that be through the principal amount or whether that be through increasing payments, they're designed so that they can help you fight inflation. So if you go to their website, it says right here, TIPS pay interest twice a year at a fixed rate. The rate is applied to the adjusted principal. So like the principal, interest payments rise with inflation and fall with deflation. So your interest payments and your rise with inflation, and your principal amount also rises with inflation. And it talks about deflation, but I seriously doubt we're going to go into deflationary environment. We started to go into one at the beginning of COVID-19, but the government said, no, we can't have that. We can't have poor people able to afford things. So they started printing money and prices went back up. So the next thing is company risk factors. So basically, company risk factors, the main thing that people get into trouble with bond investing is that you should treat a business entity as if you're valuing it for its earning power. So this is important when people go to value a home as well, or go to buy a home to live in. So basically, you need to think about the earning power of whether it be a property, you think about it as a rental property, or if it's something else, like if it's a business, you think about it in terms of its ability to cover its interest payments. So red flags would be a history of non-payment. So for example, if somebody had a bad credit score on their personal credit score for like getting a mortgage loan, you would probably not want to lend to that person. Same thing with the business. Earnings that barely cover interest charges. That's the next thing. Earnings that barely cover interest charges, that's a red flag, especially if you have unstable earnings. So last thing is earnings in bad times. So the best thing to look at is how the companies did in bad times. And that's because a lot of these bonds have long terms. So it doesn't really matter how well they can cover their interest charges in good times. It matters whether or not throughout these business cycles, which tend to happen, whether or not they can cover their bonds interest payments in bad times as well. The next topic of discussion is bankrupt companies. So here's how bankruptcies work. So a lot of people need to see this because people don't really understand why it may not be necessary to print money to get these companies over the hump. Because when you do let these companies go bankrupt, essentially what happens is you have investors that come in and they buy the assets up, or you have the bondholders that get that money from the assets. New companies are formed, and better hands essentially get their hands on those assets, that money, and they'll start new companies. They'll reemploy people, and whatever that enterprise was that failed, it goes away. So anyways, it's a creative, destructive process that is not being allowed to happen in today's environment, but that is a topic for a different time. So anyways, what happens when a company goes bankrupt? The first thing that happens is the bondholders get paid first, because like we said earlier, the bondholders have a lien on all the property of the business. After that, the preferred shareholders get paid out second, if at all, if there even are any preferred shares. And lastly, the common stockholders get paid last, if at all, which a lot of times the stock value goes to zero because there's just nothing left by the time the common stockholders get paid. That does not mean that it's not good to take part in common stock ownership. That just means that as far as the downside for bankrupt companies, the bondholders will get paid out first. But as a common stock shareholder, you get to take part in the upside. That's why people say that bonds are a little bit less risky. The only problem with that logical reasoning, though, is that if a company is on the brink of bankruptcy, you probably shouldn't be in that company in the first place. You should have seen some red flags. You should have said, I need to get out of this company. And that shouldn't be an issue in the first place. So moving on to bonds selection, and this will be the last couple things that we go over in the video, and we'll close out the video. So like we said before, earning stability in bad times due to long-term time horizon. So you're going to hold this bond for a long time, so you need to know how well they do in bad times. Interest charges, so interest charge coverage. Basically, you want to make sure that they're covering their interest charges, that they can make their interest charges every month, and that's what you care about as a bondholder. The nature and location of the business or government. So you basically want to look into what the company is that you're investing into. Terms of the issue. So time horizon, you want to look into, what the coupon is. You want to look into just everything about the business. You need to really study into the business if you're going to give them a loan, or you need to know about the government if you're going to give them a loan. Other things to consider are record of solvency and dividend payments. Maybe you want to see how many assets they have relative to their liabilities. You might want to know their current ratio, things like their working capital. You might want to look into the relation of the value of the property relative to the funded debt. Another thing to look into is the relation of the stock capitalization to the funded debt, or in other words, how much is the company able to be sold at? What's their enterprise value relative to how big the debt is? And the last thing I want to go over is you want to look over how well they are paying their bills. So how well are they paying their dividends? How well are they paying their interest? And you just basically, it's just like looking at someone's credit score before you would rent to them. It's just like when somebody's giving you a car loan. You want to do the exact same thing. You're just stepping across the table and doing that to someone else when you're buying a bond. So anyways, hopefully you guys got some good value out of this video. This is a long video about bonds. And make sure you guys hit the link to get to that Facebook page. We're trying to set up a bunch of millionaires to meet each other, some like-minded individuals. And I will see you guys in the next video.